Casey Nelson, talk about the Driehaus Event Driven Fund. There's a lot of deals out there. There's a lot of broken deals out there. So how do you invest the assets of this fund?
Sure, Greg. We invest in a variety of catalyst-driven opportunities across the entire capital structure. We're one of the few, perhaps maybe the only event-driven fund in the mutual fund world that'll use a variety of bonds, stocks, and derivatives to place our bets. We primarily look at the U.S. markets. About 2/3 of our bets are placed there, and about 1/3 overseas.
Were you involved with the Time Warner Cable Comcast deal? And if so, what do you think is going to happen next?
We sure were. That's a great example of a lot of the tremendous opportunities that we're seeing nowadays. It's been a boom in deal activity, and it's happening in large corporations, which means those companies have big capital structures, so there's a lot to do. That was an example where we saw there was a difference of opinion between what the equity arb guys were placing on deal probability, which is around 60-40 that it would go through versus not, and what the credit guys were saying, which is around 80-20 that the deal would happen versus not. So we actually got long the equity arb spread and shorted the deal, bet that it would break up by shorting long-dated Time Warner bonds. That worked out well. So in terms of what's going to happen next, we still think Time Warner bonds trade too tight to where they ultimately should. So we're looking at a trade right now where we're shorting Time Warner bonds against Charter bonds. We think the spread between the two collapses.
All right, what about the Mylan, Perigo, Teva love triangle? How are you playing that one?
That one's pretty interesting. Right now we're long Teva through call options. Implied volatility looked pretty cheap on Teva calls, and that's how we chose to play it. We are also evaluating risk reversals in Mylan. So we think doing it through an options-based format is most appropriate because you can lose a lot of money if the deal happens to go against you. It looks like Mylan wants to go it alone. Some of the language yesterday in their press release looked pretty hostile.
Well, why don't you talk about the risks associated with arbitrage? Because a lot of individual investors might want to own your fund, but you may be confusing them right now talking about long, short credit and call options, etc. So talk about the risks involved with an event-driven fund and why an individual investor might want to be involved with one.
Sure. So over time, arbitrage strategies have proven to be lower return, lower vol strategies than long-only equity strategies. So in general, most arb strategies that an investor would consider, like these in the event spectrum, they should expect to have lower risk and as well as lower upside return. The benefit is that you're getting diversification, and they're very uncorrelated to their long-only fixed income and equity portions of their portfolio. So the primary risk in a lot of arbitrage strategies are one, the deal activity just ceases to exist. The capital markets shut down, so a lot of these spreads we look at can widen out. Two, a lot of funds that do what we do could suddenly de-lever at the same time, so you could have a lot of people selling at once. But they aren't the same types of risks that you would face in your long-only fixed income or equity portions of your portfolio, which would be a declining stock market or rising interest rates or something like that.
And how would rising interest rates affect your Driehaus Event Driven Fund?
So it all depends. I guess
always does.
Yes, it all depends. So if rates were, if the back end of the curve were to rise substantially and stay that way for a long period of time, it could hurt the strategy because a lot of these catalysts that we're playing exploit synergies that are priced into some of these deals. And synergies are discounted over very long periods of time. So if you've got long-term interest rates to pop, then the value of those synergies could decline. I personally don't think that's going to happen. I do think the short to middle towards the belly of the curve could be a bit more volatile over the next couple of years, certainly. So in general, if rates gyrate a little from here in short to mid-end, it shouldn't have much of an effect at all on our fund.
All right, thanks a lot, KC.
Thank you, Greg. Appreciate it.
Thank you for watching The Street.